Why does Rory keep hearing interest rates in the news during a health crisis? Simple. Interest rates are the cost of borrowing money. In exchange for money at present, you promise to pay back that money in the future, plus a portion of what you borrowed, called the interest. Currently, people are compelled to borrow because they are earning little to none. Interest rates are set by central banks to control our country's money supply. Methods of controlling money supply are called monetary policies. If the BSP lowers its interest rates, that means it wants banks to borrow more from BSP funds, so the banks will have more money to lend out to people. Interestingly, central banks lend to banks like banks lend to individuals. For example, one way that banks can borrow money is by exchanging money from the BSP with government securities as proof of the borrower's obligation to repay the loan. By releasing money into the economy, the cost of borrowing money decreases. Now, what exactly is the task of monetary policy in the time of COVID-19? Well, think of it as fuel, and the economy as a machine. With enough fuel, we can keep the machine running. The role of monetary policy is to provide enough liquidity to an economy hampered by a supply shock due to unforeseen production freezes and hit by a demand shock, as seen in the hoarding of alcohol and toilet paper in stores. It is a necessary tool to help cushion the country's growth momentum and minimize the risks of financial instability. Knowing what monetary policy is, we take a look at what the BSP is doing to combat the pandemic's negative economic effects. To give a much-needed boost to the economy, the central bank has responded with 4 important measures: cutting its policy rates, lowering banks' reserve requirement, buying securities from the government, and providing relief to MSMEs. The first response is the policy rates cut. By making it cheaper for banks to borrow, these banks in turn can lend out more to businesses and consumers. On March 19, 2020, the BSP lowered the overnight reverse repurchase facility, which is a tool used to set the policy rate, by 0.05% down to 3.25%. And on April 16, another 0.05% cut brought the policy rate to 2.75%, the lowest rate on record for the BSP. Second, the BSP cut reserve requirements. Cutting down on this allows banks to lend out more of their funds instead of having to keep them in reserve. On March 24, the Monetary Board authorized a maximum of 4% in reserve ratio cuts, and so far, a 2% cut has been announced. The BSP also purchased 300 billion pesos worth of securities as part of a repurchase or repo agreement. Under this arrangement, the Treasury sells the central bank its securities and then buys them back within 6 months at the same price. The repo agreement funnels money directly into the government's hands, allowing the government to have funds usable in its pandemic response program. Additionally, the BSP has provided relief to MSMEs, which account for the majority of the total establishments operating in the country. This help comes in the form of postponing the implementation of new regulation so small rural and cooperative banks can continue extending credit to their MSME clients. The government has evidently taken steps to lessen the economic impact of COVID-19. But are these enough? As of now, it is still hard to determine the overall effect of the monetary policies implemented because these policies work with a lag. However, the BSP must develop more measures to keep our financial system afloat. Moreover, all sectors must come up with radical solutions to ensure that the economy will be stable and that each Filipino can attain their needs. By all means, the government must provide all that it can for the welfare of the people.